Hello and welcome to week 15. Next week is our last week of the semester. So today we're going to be going over partnership accounting, which is actually a pretty easy chapter. And I just remembered I forgot to open up my exercise set. So I'm going to pause the recording and do that. I'll be right back. Okay, that's better. So I do want to go over a couple of things before we get started. One thing that I'm going to mention on behalf of the Hartnell College Faculty Association, which is our union of faculty members, we are currently in negotiations with the Hartnell College District about various things about our union contract. And I'm going to take a moment just to tell you some of the things that the faculty members are asking for. And so far, the Board of Trustees is not really cooperating. They've come back with a much lower offer. And so I wanted to let you know about it because we would like your support if you think that the Board of Trustees should get behind the faculty members and give them a better contract. Your voice makes a difference. And the way you can share your voice would be either at an upcoming Board of Trustees meeting, which happens every other week, which any member of the public, especially if you live within the Hartnell College district, which goes all the way from Castroville down to King City, is welcome to give up to a 3-minute talk in front of the board. So that's one way you can support the faculty. But another way is we have these postcards that we made up. And if you would like, you could pick one up at my office, or I could mail one to you. And you can just write on there your feelings that you would like to share with the board, or your thoughts, and let them know that way. And I think it's helpful if you put your name, but even if it's anonymous, that would be better than nothing. So let me just take a moment and tell you what it is that the faculty members are asking for, and you can determine whether you think it's reasonable. We are asking that healthcare benefits be offered to the part-time faculty members who currently do not get any healthcare from the district. And there's funding from the state to pay for it. So it's not like it would really cost the district much money to offer it. We're asking for a cost of living adjustment in our compensation. So the state approved about an 8% cost of living adjustment for the colleges, but for some reason that's not being passed on to the faculty members. So it seems reasonable since inflation has gone up about 8% in the past year, and the state is giving that money to the colleges. Why wouldn't the Board of Trustees pass some of that on? Pass on an 8% salary increase to the faculty members. We're asking for smaller class sizes because the more students there are in a class, the less attention we can give to each student. We're asking that whether we're teaching a lecture or a lab, that those be paid the same. Right now there's this complicated formula for labs getting paid less for some reason. We're asking for faculty chairs. And so these folks would be, they would do some of the work that's currently on the shoulders of the faculty members. So things that the deans don't want to do or don't have time to do, instead of putting that on the shoulders of the faculty, they would be done by faculty chairs. So it seems like a reasonable idea. A lot of colleges do that. And the last thing, our counselors are allowed to work remotely, but they need to be on campus when they're working remotely. And during the pandemic, they were able to work from home. So another thing we're asking for is, well, when they're working remotely, why can't they just work from home instead of having to come to campus? So those are our requests. Again, if you agree with the faculty members that we should have some or all of these things we're asking for, then if you would like a postcard to provide to the board, let me know. I can get it to you. Or if you want to show up at a board meeting, and speak before the board, you have that option as well. I'm not sure when the next board meeting is though, because we're going into summer, so I'm not sure what the schedule is. But that's all I will say about that. If there are any questions or comments, feel free to get in touch with me. So let's move on to our chapter. Well, actually, I've got some other announcements. I just remembered there is a video number 4 discussion. This is our last video discussion. It's due by the end of next week, which is a Saturday. Normally our weeks end on Sunday, but the last week of the semester ends on a Saturday. So make sure you get your main post and your replies in by then, but preferably I would say do it this week. I know you're going to have finals and other courses and projects and things like that. So I would encourage you to try to get your discussion posts in either this week or early next week, okay? And I think we do have a couple of people who started participating in that already. Then, and of course, you can find that link under the Chapter 16 module. There is an announcement I posted. Some of you may have already done it, but there's a quick poll. When you click on this, let me see if it's going to work here. Yes. It's going to ask you how you learn best. So out of these 8 options, think which one is the most effective for you to learn. And then once you select what you think is most effective, you'll be prompted what's the second most effective, and the third all the way down to the 8th most effective, which obviously would be the least effective way. And it's very interesting for me to see the results from this. Every semester, I use that information to refine the courses. And some of you have already done this. I appreciate it. But those who haven't, if you could do that this week, that would be great. Okay, so I can get your input. Very quick and simple poll. There is also a final course survey, which is different. You can access that under the Chapter 16 module. So let me show you. From Chapter 16, the survey is the very first link. You'll see, oh, there is an accounting stuff video for, actually there are a couple of them for the Chapter 16 that we'll get to next week. That's kind of a tough chapter, so you might find those accounting stuff videos useful. Here under Chapter 16, you also see the link to the video discussion and to the final exam, which is also due by Saturday, the 20th of May. Okay, so make sure you get that in by the end of the semester. The final, once again, is 50 questions, multiple choice, very similar to the midterm. The questions are all questions you will have seen on previous chapter quizzes. And mostly it's going to be drawing from chapters 9 through 16, but there will be some questions from chapters 1 through 8. And I'll remind you that in the textbook, there is an answer key to some of the questions from the chapter quizzes, so you can cross-reference the multiple choice questions in each chapter with the answer key, and that might help if you're unsure of some of the answers. And since the exam is open book, you can look in the textbook and use other sources to try to find the best answer. So you'll have 3 hours. Once you begin it, you only get 1 attempt. So make sure you've got a good internet connection and no distractions, because this is worth up to 7 points. All right. So let's see what else we got. Survey covered that. Okay, there was an announcement here. There was a presentation just yesterday by a graduate of Cal State UMB who went on to then get a master's in accounting. And she talks about the job she had in accounting, both before the master's and after the master's. And her job today involves flying around the world to different countries, any place where Driscoll's sells their berries, which apparently is all over the world, to learn about the tax laws and regulations in those different countries to make sure that Driscoll is in compliance. And she talks about how she and her team have been able to save Driscoll's millions of dollars. So they absolutely love her and her team because of the good work that they do. And that's a good position to be in. She compared it with auditors. She said she had the choice to go into auditing, but she's glad she went into taxes, because what she realized, when the auditor walks in to their client's company, they're not that welcome because the auditor is there to look at the books and really, figure out if everything's done properly. Whereas when the tax manager comes in, people are like, oh, great, you're here to help us save money on taxes. So it's a much more positive experience. So that was interesting to hear. Anyways, there's a recording of the talk that she gave. CSUMB shared that recording with us. So I would recommend you check it out. It's about an hour long, and I think you'll find it really interesting. And the other thing I wanted to touch base with you on is our course project that is due this Sunday. So hopefully you are in process. You've chosen a publicly traded corporation. You've started to research it. You've downloaded their annual reports and found their financial statements for the past 4 years. You have found some news articles about the company within the past year, hopefully not any older than that. And you have started to fill in the template, which again, you can download right here with this little arrow with the information and analysis that you have done on the company. So if you have questions or if you run into any problems, let me know. Okay, but that is due on Sunday. So upload that PowerPoint file by Sunday evening. Okay. And it doesn't matter if you're using Google Slides or Keynote, whatever program you're using, just make sure you save the file in PowerPoint format and then upload it to Canvas. Okay, I think that is everything. So let's begin. Oh, there's my to-do list. You didn't need to, oh, there's my calendar. You don't need to see any of that. Okay, let's get into nothing to hide, just, nothing really interesting there. So let's get into chapter 15. Again, this is a fairly easy chapter in my view. I hope you'll agree with me. This is about how we do accounting specifically for partnerships. So that's going to be a little different from corporations or, of course, sole proprietorships. And really, there are a lot of parallels. So the way we do accounting for partnerships, well, the investors or stockholders are the partners because they're the ones that own the company. They don't get dividends, but they do get capital, and they can withdraw that capital out of the company. They invest capital, just like investors do, but instead of that going into stock, it's going into their capital accounts. And when a partnership has a profit, instead of retained earnings, it increases the capital accounts. So with partners and partnerships, it's really all about their capital accounts. That's where we keep track of the profits, the investments, and the money that they end up taking out. All right, so the first exercise here, we've got 2 partners, and the first partner is named BJ, and BJ contributed $80,000 in cash. Okay, so we're going to journalize that. And BJ also contributed $50,000 of equipment. And so in exchange, since this equipment now belongs to the partnership, not to BJ, the partnership is awarding $130,000 of capital to BJ. Okay, again, that's kind of like stock. If someday BJ leaves the partnership and cashes out their capital, well, basically that's how much money they have to cash out. You'll see that there are some exceptions, but if the company has profits and the profits get divided up based on how much capital each partner has, which is typically how you do it, then again, the more capital you have, the more share of the profits you get. Okay, so for this first transaction, we debit the cash and equipment that the company got. We credit BJ's capital account. The other partner is named Paige, and she contributed $20,000 in cash, $60,000 in equipment, a $240,000 building that she gave to the partnership, but also she owed $100,000 on that building, and that debt has also been transferred to the partnership. So that really decreases the value of what she gave, right? Because she's giving these assets, but also she's giving a liability. So that liability reduces how much credit she's going to get. So what we're going to do here is add up our assets. So we got the 20,000, the 60,000, and the building. Okay, so she contributed 320,000, but she also transferred that debt over, so that reduces her capital by $100,000. So 220,000 is the amount of capital that the company, the partnership, is allocating to Paige. Okay, so we have journalized her capital, and we can go on to exercise 2. By the way, we have only 4 exercises and 3 problems. So we should go through this fairly quickly today. Okay, here we've got a partnership between Chase and Chloe. Partnerships can have more than 2 partners, but to keep it simple in this chapter, they all have 2 partners. Okay, so Chase and Chloe, they share profits and losses on a 70-30 ratio. So 70% goes to Chase, 30% goes to Chloe. Chloe also gets a salary. Now, when a partner gets a salary, they are not an employee. That salary is basically paid in capital to the partner for their work. And then again, they can take some of that capital and they can cash it out, but they're not an employee, all right? So we're going to show in 3 different situations how we're going to allocate the capital. In the first situation, the partnership earns a profit of $30,000. So the way we do this is we start with that. So the amount partnership earned is the total income that we're going to have to divide. Okay. Now, first, we need to pay the salaries. Chase doesn't get a salary. Chloe's the only partner that does get a salary. They might have employees that get salaries, but that's a different story because that's paid out of, the operating income and cash flow. So that's pre-profit, right? This is out of the profits. 10,000 is going to Chloe as her salary. And that plus 0 for Chase equals a total of 10,000. Okay. So now we know the total salaries being paid to partners. The next step is we need to find the difference between the total profit and the salaries that are being paid out. So we could take the $30,000 profit minus the $10,000 in partner salaries, and that's a difference of $20,000 of other profit that we can allocate between the 2 partners. And again, the way they do it is that 70-30 ratio that these partners agreed on. So 70% of 20,000 is going to Chase, and 30% is going to Chloe. Okay. So you just multiply 20,000 times 0.7. That's how much goes to Chase times so 20,000 times 0.3. That's how much goes to Chloe, right? Now we add up our columns. So Chase gets a total of $14,000 of capital. Chloe gets a total of $16,000. All right, and if we want to check our numbers, if we add horizontally, 14,000 plus 16,000 does equal 30,000. So that helps double check our calculations. All right, so that's all we do for A. Let's go on to B. In B, our total profit is 6,000, right? That's what it says up here. So again, that's the total income we're going to divide. Now the salaries are the same. In all three scenarios, Chase gets 0, Chloe gets 10,000, and the total is 10,000 in salaries. So you might be wondering, but wait a minute, how can we pay 10,000 in salaries if there was only 6,000 in profits? Good question. So again, what we do is we take the total income, 6,000, subtract the total salaries, and we see that the difference is negative 4,000. So we're going to have to split that and take it out of the capital accounts of the two partners. We're going to use that same 70-30 ratio. So 70% of 4,000 is 2,800. 30% of 4,000 is 1,200. Okay. So we're dividing that $4,000 negative amount between the two partners. So the total for Chase is his capital account is going to go down by 2,800. For Chloe, because she had that salary, when we subtract the $1,200, that leaves 8,800 that her capital account is going to go up, right? Because 10,000 minus 1,200 equals 8,800. Then if we want to check our numbers, we could say negative 2,800 plus 8,800, and that equals 6,000. Or another way you could do it is 8,800 minus 2,800 equals 6,000. So either way, it confirms our numbers are correct. And we see how the income would be allocated. All right. It would actually be a loss for Chase, but it would be a gain for Chloe. I shouldn't say gain. It would be an increase in capital for Chloe. I guess technically, well, no. Okay, never mind. Let's go to the last example. In the last example, the partnership lost $10,000. So again, we're going to put that in the total income, even though it was negative. So it's a loss. And then again, if we take that number, that negative $10,000, subtract the salaries that are getting paid out of $10,000, we get negative 20,000. So in other words, the partnership lost money and it had to pay out $10,000. So that's a total decrease of $20,000 of capital. That then has to get allocated between the two partners. 70% is going to Chase, 30% is going to Chloe. We then add up. And we get 4,000 for Chloe. Again, we can check our numbers. Negative 14,000 plus 4,000 equals negative 10,000. So that looks correct. So there we go. Okay. So there are a lot of steps. Hopefully you've made note of the steps and you find that with a little practice, it makes sense. Let's go ahead and move on to exercise 3. Here again, we have two partners. They split 50-50. And they've each contributed $45,000 into the partnership. Then a third partner is coming in named Ashanti, who is going to invest $60,000. However, the three partners have agreed that they are going to split everything evenly among the three of them. Okay, so let's see what this looks like. The two original partners, again, each contributed $45,000 in capital. So 2 times 45,000 equals $90,000 of capital before they bring in the new partner. The new partner is contributing $60,000. So now there's a total of $150,000 of capital, right? They're going to split that 3 ways. So that means Ashanti gets $50,000, even though Ashanti contributed $60,000, right? He contributed $60,000, I'm assuming in cash, but he's only getting $50,000 in capital. So that other $10,000 of capital that he just funded with his contribution is a bonus to the previous partners. Because remember, their capital balances previously were $45,000, but now that they're splitting the capital 3 ways, they each have $50,000, right? So how did that happen? Well, Tasha got a $5,000 bonus in her capital from Ashanti's $10,000, and Bill got the other $5,000. Okay. We'll do another one like this in the problem set, but that's how you do it. There can be a case also where the existing partners pay a bonus to the new partner. That's also a possibility. That would be in a situation where they really want that partner to come in, and so they provide this incentive to get them to become a partner. Okay, and the last exercise here, we're going to see how we close out a partnership. So if you have a partnership that's shutting its doors and going out of business, this is how we would liquidate the remaining assets of the business. Okay, so we see here the current balances in each of the accounts of this partnership. We see that a competitor is going to buy the inventory and the store fixtures for $20,000. We need to journalize everything, and the partners share on a 50-50 basis. Okay, so the first thing we need to do to liquidate out the business is to sell the assets. So the only assets are the $15,000 in inventory and the 10,000 in store fixtures. So that's $25,000 in assets, but the buyer only offered $20,000. Okay, so if we accept that offer, we get $20,000 in cash. And that means that we got less than the book value of these assets, right? We're assuming the depreciation has already been calculated in here. So we got less than the book value, and we call that a loss, right? And the way we debit that is loss on sale, $5,000. If it were a gain, we would credit the gain, but because it's a loss, it's a debit. And it makes sense because 25,000 over here equals 25,000 over here. All right. Welcome, Jane.
Hello.
Hello. So we're about halfway through, but you'll be able to see the recording later. So I'm just finishing up the last exercise, and then we'll move on to the problem set. Okay, so we went ahead and sold the assets. Now the loss of $5,000, that reduces the capital of the partners, just like losses for a corporation, losses on the sale of assets, or losses from your operations decrease your retained earnings. And profits and gains on the sale of assets increase your retained earnings. With a partnership, it's the same concept. It's just that instead of retained earnings, it's partner capital. So to get this loss off of our books, because again, we're liquidating the company and closing out the books, we're going to credit that loss. And instead, we're going to distribute it and decrease each partner's capital by $2,500. Okay? So their capital goes down. The next step is we have to pay off any debts. The only debt the company has is an account payable, which is normally a credit, but because we're paying it off, we need to debit it. And we need to credit cash because that's what we actually had to spend to pay off the debt. Okay. And lastly, let's see. Oh, then we're going to go ahead and close out any remaining capital and just pay out as cash to the two partners. So let's figure out how much capital there is at this point. We started with $9,000 worth. The capital went down here by $5,000. So that left $4,000 remaining, right? So we'll decrease Colette's capital account by $2,000, Swarma's by $2,000, and that's it. It closed out all the capital accounts. Now, that would mean that there's $4,000 of cash. That would be the only assets remaining in the company. Let's confirm that. If we take a look, we had $6,000 of cash. I'll underline that just for reference. And we got 20,000. So 6 plus 20 gets us up to 26,000 in cash. Minus the 22,000 we paid here gets us down to 4,000 in cash. And that is exactly what we're paying out here at the end. So after this process, the company has no assets, no liabilities. There's no partner capital left. Everything's been completely zeroed out. Okay, so that's how we would close out the books on the partnership. So that's it for the exercise set. Let's go ahead and take a look at the problem set. I'm going to go through part of each problem with you, and the other parts you'll do on your own. For problem A, we're going to do part C together because I think that's the harder of the three. You'll do A and B. So problem 1, you'll do A and B, but we'll do C together. Okay, here again, we've got two partners. They have a 60-40 split. Each partner has a salary. Tatum gets 10,000, Brooke gets 15,000. Okay, and in the scenarios you'll do on your own, the first one, the partnership has a $40,000 profit. The second one, they've got a $25,000 profit, but the one we're doing together, there's a $5,000 loss. Okay. And down here, don't worry about the balances in their capital accounts. You don't need that information for this problem. That's just to confuse us. So you know what I'm actually going to do here? I'm going to copy this down just so it's a little easier to see. And then let's try to get it all on one page. Okay, that ought to work. Okay, so this is problem 1C. This is like what we did before. We have to first put in the salaries. Well, actually, first thing we'll do is we'll put in the total loss, right? Which from C was a $5,000 partnership loss. Then we're going to put in the salaries. We had 10,000 for Tatum and 15,000 for Brooke. So that's a total of 25,000 in salaries. Okay. The next step, as you might recall, we take the total income or loss and subtract the salaries. So negative 5,000 minus 25,000 is negative 30,000. So that is the amount we need to split between the two partners. Again, they have a 60-40 ratio. So if you take negative 30,000 times 16, sorry, let's say that again. If you take negative 30,000 times 60%, that's negative 18,000. And negative 30,000 times 40% is negative 12,000. Okay, our last step here is we're going to add each column. So 10,000 minus 18,000 equals negative 8,000. And 15,000 minus 12,000 equals 3,000. And then we can double check that. Negative 8,000 plus 3,000 equals negative 5,000. So yes, that is correct. Okay, so we calculated the impact on each partner. Again, part of that impact comes from their salary, part of it comes from the division of the remaining income or loss, right? And so Tatum's capital account is going down by $8,000, and Brooks' capital account will go up by $3,000. So the last step here for this problem is we need to journalize it. And notice that we do not put a minus sign in the journal, right? We always enter as positive numbers. But you might be thinking, Tatum's capital went down, right? So how do we indicate that Tatum's capital went down? Well, the way we do that is by debiting Tatum's capital, whereas Brooks' capital, who's going up, is getting a credit, right? So Brooke is going up with the credit, Tatum's capital is going down with the debit, okay? Now you might notice here income summary is the other account. When we close out the books in a partnership, we use income summary just like we did with a corporation. So what you would do, the 4-step closing process, and we don't have to do that in this chapter, but if we were closing out the books at the end of the year for a partnership, we would first close out revenue to income summary. Then we would close out expenses to income summary, just like we would do with a corporation. But then we would close out income summary to the capital accounts of the partners. And then the last step is, instead of dividends, we would close out the capital accounts of the partners to their drawing accounts where they can actually take the cash out. So that's just for reference. But we are done here with problem 1C. So if there are no questions, we'll go on to 2A, and then you'll do 2B and C on your own. So this is another one where the partnership is bringing in a new partner. We have Arun and Margot, and they each have $50,000 of capital before Tammy comes in as a third partner. And they were splitting 50-50, but with Tammy coming on board, they're going to split everything 3 ways. So that means the assets, but also the liabilities of the partnership get split evenly between the 3 partners. Okay, in scenario A, Tammy's contributing $20,000. When you do B, Tammy's contribution will be $80,000. And when you do C, her contribution will be $50,000. Okay. So the beginning capital, again, it was $50,000 for Arun and $50,000 for Margot. So that's $100,000 of capital initially. Then Tammy comes in and contributes $20,000. So now we have a total of $120,000 of capital. We're splitting that 3 ways between the partners, which means Tammy gets $40,000 of that. Not in cash, just as capital. And since she contributed $20,000, but she's getting $40,000 in capital, that means she's getting a $20,000 bonus of capital that's coming from her other partners, that they funded that bonus. How did they fund it? Well, 10,000 comes out of Arun's capital account. The other 10,000 comes out of Margot's capital account. Okay. And the way we would journalize this, Tammy contributed $20,000 in cash. Arun gave up 10,000 in capital. Margot gave up 10,000 in capital, and Tammy got 40,000 in capital. Okay. So that's what our journal entry looks like. Let me, I'll move it down a little bit so you can see it without that page break in the middle. Okay, so that's our journal entry. Again, you'll do B and C on your own. And if you have any questions when you do that, let me know. We are now at our third and final problem of the week. All right, when a partnership is liquidated, so when it goes out of business and you sell all the assets, pay off all the debts, and then use any remaining money to give to the partners, any gains or losses realized by the sale of non-cash assets are allocated to the partners based on their income sharing ratio. What that means is when you sell the company's assets and there's either a gain or a loss, the way you split up that gain or loss is the same way you would split up the profits or losses from their operations. So if it's a 60-40 split and you have a gain from selling assets, you split it 60-40. If the partners have a 20%, 80% split or whatever it might be, the gains and losses from the sale of assets would follow the same ratio. And the question here is why? And it's one of those things like, why not? It's just the easy way to do it. It makes sense that if your profits are going to be split according to a certain ratio, and if the company's losses get split by that ratio, it would make sense that any gains or losses from selling assets would follow the same ratio because they are either increasing the capital of the partners or decreasing. So why not just keep it the same ratio as the profits and losses? So we can say something like gains and losses influence partner capital just like profits/losses. So it is only logical that we would split them according to the same ratio. Something like that. It's a very loud keyboard, I know. Okay, so that is our answer to problem 3, and that is it. This, I think, is our shortest lab of the whole semester. Next week won't be so short. Chapter 16 is kind of challenging. So I encourage you, get that course project, maybe your final exam, your discussion post, try to get as much of that done this week so that next week you can focus on chapter 16 and anything else you've got going on in your other classes. But that's all I have for you today. Jane, if you have any questions, you can let me know. Otherwise, we'll just call it a day.
No question.
All right, Jane. Sounds good. Have a good rest of the week and just email me if anything comes up. All right. Otherwise, I'll see you later.
Bye.
Okay. Bye-bye.